Hello viewers, I hope you are having a great summer so far. 2025 won't be the last year in history without any scary headlines from the media. If you go into each year expecting some rough patches for the markets, you would really be doing yourself a favor because you will be less likely to make a rash decision. The time to prepare for a storm isn't when it's happening, but before it arrives. Here are two timeless lessons to learn from. First, volatility is the toll you pay to invest. Here's a chart showing the various declines per year from 1928 to 2024 that the S&P 500 has had. You can see on the left-hand side, on average per year, 7.2 declines of 3%. 3.4 mild corrections of 5%, and even 1.1 corrections of 10%. A severe correction of 15% has happened once every 2 years, and a bear market of 20% has happened once every 3.5 years. Again, these are the declines you could possibly see every year or so. I often hear from investors that we are due for a correction, or I don't want to buy right now because I think the markets are going to go down. Well, here is my second lesson, that bull markets last longer than you think. On average, for the S&P 500, a bull market lasts 67 months. Currently, the bull market for the S&P 500 is 31 months old, meaning we are still less than half the average bull market length. Going back 50 years to 1975, once a bull market gets into its third year, like we are in this year, the shortest it lasted was 5 years, with an average of nearly 8 years. This means there could still be a lot more runway for the bull market we are in. Bottom line, we might see more volatility this year, which would be perfectly normal. I still believe there is opportunity in the markets, and those with a longer term time horizon should look past the headlines. Want to learn more about our strategies? Follow us on Facebook at Pukalo Prairie Wealth Group. There's a link to our page below. As always, I'll be in touch next month. Thank you for listening.